Hello, everybody, and welcome back. How healthy are Asian banks and financial service providers? This is a question many of our viewers are asking themselves in light of the events at Silicon Valley Bank and Credit Suisse. I'm looking forward to talking to a great expert today. Peter Monson is a senior portfolio manager at the Asian ex-Japan equity team at Nikko Asset Management. Welcome, Peter.
Thanks very much, Thomas, and thanks everyone for tuning in. Glad to be here.
Peter, with the collapse of Silicon Valley Bank and the force majeure of Credit Suisse, memories of the financial market crisis are back. What is different today than in 2008?
I think certainly in the case of banks, it is very different now versus 2008. I think it's precisely because it is in recent memory that we're making comparisons with the global financial crisis. Any tightening rate cycle, particularly one as abrupt as we're seeing, will result in some lapses and some risk management issues coming to the surface. And the question is whether this is isolated or symptomatic of broader issues. And there's some major differences then to highlight. I think one is there's much more stringent regulation around now. So capital ratios and leverage is much, much better. As a result, there's been much less excessive risk taking by banks more broadly. You know, the examples we've got here, there's two crypto-oriented banks. SVB was very much a tech startup VC funding bank, and Credit Suisse seemed to be in every major blow-up that happened in recent years, from Greensill to Archegos, and multiple sort of failed restructurings. That's not to say that there hasn't been some excessive risk-taking in particular areas, but we would probably contend that's more in the non-bank financial sectors. And this is probably the last major difference to highlight, is just the run-up to 2008. The credit build-up from banks was much, much more than it was today. I think its credit to GDP in the US is flat over 10 years, and it was up sort of 25 percentage points going into the GFC. So there's a lot of differences in terms of where the risk has been put on in the last 10 years versus the build-up to the GFC.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now.
So let's go even further back in time. So many older investors still remember the Asian financial crisis of 1997. What has changed since then in Asia?
Yes, many older ones and some younger ones and students of financial history too, I would say, Thomas. It is referred to as the IMF crisis by quite a few people over here in Southeast Asia, but I digress. I think some of the biggest changes in the financial sector, at least, have been institutional reform and regulatory oversight. There's much less ownership by influential families here today, a lot more capital market ownership. There's been the establishment of independent central banks and financial regulators. And just on the policy side, it's been much, much more prudent than it has been in the past. Capital requirements are a lot higher. Funding is now nearly all deposit-based versus a lot of wholesale before. And increasingly, there's a lot of counter-cyclical policy. Singapore, for example, tightened debt servicing ratios even before the Fed started this tightening cycle in advance. Taiwan's another one where they've learned the hard way, and they only issued 3 digital banking licenses this time around when there really was quite a fervor in other countries, and they were quite limited in terms of what scope you were able to do. So you're not going to have a 42 billion digital banking run happen in Taiwan now, for example, which is what we saw at SVB. But I think while there's probably entire books on the topic, and if viewers are interested, you can feel free to reach out on more questions, but it would be institutional reform, regulatory oversight, and policy prudence from most.
What are the differences in the funding and liquidity profiles of Asian banks compared to institutions from the US and Europe?
Yes, without getting too technical, I think as we mentioned, funding is nearly all deposit-based for the majority of listed banks. And in most instances, this is quite diversified. It's retail-based. It's quite sticky. There's no bank in our markets, for example, that relies on startup or VC deposit base that can go out the door very quickly. Again, the liquidity coverage ratios and net stable funding ratios, they're either in place or being phased in across all markets and banks. We didn't see any relaxations like we did in the US for regional banks, and most important banks are comfortably above those regulatory minimums. I think lastly, and one very important new characteristic that was laid bare by the SVB episode in particular, is that of digital bank runs. And every bank run in history up until this one was done in person, hence it took a lot longer. It took days and weeks, whereas now we're talking about hours and hours to withdraw $42 billion. We think there's a lot of opportunity in terms of digital banks or banks that bring in a lot of digital competency to their business model in parts of Southeast Asia. But one has to be very careful about which to invest in, both from a timing perspective, but also in terms of which can make it longer term. And a key part of that is the quality of their deposit franchise.
Bringing some technical expressions that we are now getting used to it. What roles do additional tier 1 capital and cocoa bonds play in Asian banks funding?
So overall, there's much less reliance on additional tier 1 capital in Asia. Really is sort of relatively small amounts of total capital ratios. And in fact, in most major banks, they do meet capital requirements purely on core equity alone. Bank Central Asia, for example, which is Indonesia's largest bank, has a core equity tier 1 ratio of 26%. That's versus the regulatory minimum of 8% and relative to the 13% average of globally systemically important banks across the world. So very, very little.
How are Asian banks in general coping with the shock of rapidly rising interest rates?
It's something we're all coming to terms with. But I think in like most other cycles, we're seeing some increases in credit costs, some tightening in origination standards and growth outlooks. But there's a few important considerations to highlight. The first would be that in Asia, rates have moved up an awful lot less than the US and Europe developed markets. I think we're only about 240 basis points on average versus 475 basis points in the US. And remember that China, they've actually decreased interest rates during this period of time as well, which is often overlooked. The second aspect to this is that rates are only back to 10-year averages in Asia. We're at normalized levels, while they're considerably above in most developed markets where zero was the new normal for the last 10 years. So we therefore didn't have that sort of big chase for yield like we saw in maybe some other financial systems. And I think lastly, and more importantly, is we do have some partial offset in China's reopening and the impulse in terms of growth, in terms of tourists that gives to the region, and Asia is the most leveraged to that, and increasingly so.
What are the regional differences between banks in different countries like Japan, China, India, Singapore, or Taiwan that you are observing?
Yeah, again, this is something we could talk about extensively, and I think it is very, very important to realize and understand how varied and nuanced each Asian economy really is. But if I try and simplify it into a few key points, one is the variety in the stages of economic development. You've got countries with $2,000 GDP per capita up to 60,000 GDP per capita. So what you need out of your financial services or the opportunities are very, very different. In India, it's about basic banking and access to that. But in Singapore, the opportunities might lie more in wealth management and private banking. A related point to that is the stock of debt. And we do have quite high debt penetration economies like China, Korea, Thailand. And then on the flip side, very low penetration economies like India, Indonesia, and Philippines. And historically, part of the issue with those ones is that, particularly with island nations, Indonesia, Philippines, the cost to serve customers is quite punitive. It gets more and more punitive the more rural you go. But the cost to acquire has completely changed with digital channels, at least according to one of the banks we spoke to recently. It can be up to a tenth of the cost to acquire in a branch. So accessing these opportunities are becoming much more feasible, and that's creating longer term opportunities. A third consideration probably is demographics, aging, and welfare provision. It's very, very different across economies. But we see this as a sort of considerable opportunity, maybe more for healthcare and insurance and long-term welfare providers, but in some instances, banks as well.
What scope do Asian central banks have to counter a possible credit crunch in the sector?
I think one of the biggest differences is quite simple. It's around the inflationary dynamic. I think the problems or pressures are much less pronounced here than they are in some of the developed markets. We do have a huge stock of excess labor in a lot of countries. And this is now resulting in real rates coming back. So banks have tightened already. Inflation is starting to come down in a lot of countries, and it will give room for policyholders to cut benchmark rates if they need to. I think the other advantage of being more prudent with regulation in good times is that you have more room to ease macro and micro prudential policies when times get tougher. So, for example, Singapore and its debt servicing regulations, they can start to relax that if needs be, because it's already very, very punitive. Most countries also still have significant reserve requirements, requirements that banks have to hold at central banks, which can be released back into the system if needs be. And there's also quite a lot of room for positive reforms and just encouraging more foreign investment into bond and equity markets that can happen too. But overall, I think it's fair to say there's enough in the policy toolkit if it comes to that.
Are there any institutions in Asia that are at risk in the current situation? And from your perspective as a portfolio manager, which stocks are you currently avoiding?
We don't look at Asian financials just through rose-tinted spectacles. The research that we have done suggests there's probably more issues in developed market banking systems and the non-banking space in particular. That said, we have to be aware of where feedback loops and contagion can happen, as global financials are still pretty interconnected. And there are pockets of risk that exist in countries with, say, high stock of debt. We mentioned Korea, China, Thailand before. The other difference, though, with those is that China's been cutting rates. Korea and Thailand are probably now on hold and not at very elevated levels. Elsewhere, we talked about digital bank runs. There has been quite a bit of growth in digital banks in some countries in Asia. Thankfully, it's only really Korea where they got up to a sort of scale that might be more problematic at a system level. But those are an area to keep an eye on. And then it's really in the non-bank space. We've seen a bit of this creeping through in insurers in Taiwan the second half of last year in some of the banks, and then project financing in Korea, where asset values of investments have had to come down and be marked to market and require capital calls. Project finance just tightening up. There are pockets of that, but again, it's not being broad enough to impact whole credit systems as yet. And thankfully, I don't think anywhere near the sort of scale that it has been in developed markets.
Financial services in Asia are generally considered a growth market. So to what extent have recent events changed valuations and the attractiveness of the sector?
But we haven't seen anything yet which I think dents the long-term growth opportunities in specific Asian financials that we like and cover. I think in most cases, you can actually see the opposite longer term. Take Singapore banks, for example. So private banking and wealth management AUMs have grown about 10% CAGR over the last 10 years. And you'd have to ask yourself, has what happened to Credit Suisse helped or hindered the longer term outlook for Singapore banks and that flow of money? The other one would be, take those underpenetrated economies we talked about in the region. These are the ones that should benefit the most from digital banking. And those more traditional banks, which have invested in their core technology capabilities, are now seeing less competition from challengers, as access to capital is a bit more limited. And it's their room to take more market share on that going forwards. We have to also look at some of the countries that are going through positive structural reforms, places like India and Indonesia, which are really looking to encourage investment and manufacturing to come and be built up in those countries. That presents good opportunities for banks in both of those. And again, it's probably market probably are overlooking the positive impact of China's growth impulse to the rest of the region, and that's softening some of the pressures. That said, valuations have corrected to what look like pretty attractive levels longer term, as credit risk being priced in and some of the peaking in interest rate cycles being priced in. I do think we probably need to remain patient in the shorter term. There probably will be more casualties from higher rates as long as the Fed keeps going. But looking longer term, this is starting to look to us at least like some pretty good opportunities for what we really look for in investments, which is undervalued, positive fundamental change, and high sustainable returns. So it's an area we're definitely watching very closely.
So this was Peter Monson from Nikko Asset Management. Thank you very much, Peter, for being with us today and sharing your insights into the Asian banks and financial services market.
Thanks very much for having me again, Thomas.